Okay, well, I think we're live. Welcome, everyone. Thank you all for joining us to our every two-weekly live stream. And it's nice to see so many people already. That's good. So let me just tell you a little bit about the way we usually run this. Many of you I see are old hands. So Alain, obviously, nice to see you. But if you do like us, it obviously helps a lot. If you sign up, then you'll see our future content. And if you do like the stream, it would help us a lot. Anyway, so let me just start working my way through the questions. And also, hello, Tim. Nice to see you. So Tim actually was off the very quick to post a question. Hi, Ramin. Since inception, the FTSE 250 market cap has grown from 98 to 318 billion, while the index has grown from 2.4k to 18k points, implying an extra 3% per annum of growth has come from acquisitions. As it happens, this is approximately the outperformance of the FTSE 250 versus 100. Your opinion on whether this is sustainable over coming decades? So I guess what you're talking about there is the acquisitions, whether those are sustainable. I suppose to some extent, yes. As long as you're always creating new companies, it is sustainable to have acquisitions, and there always will be new companies. So to a certain extent, yeah, it is sustainable. What's interesting is if you look in the US, you actually see the opposite. You see the number of shares reducing over time because of share buybacks, which is kind of interesting. So in the UK, it sounds like, based on what you're saying there, we've got the opposite situation. But obviously for the share price, it's better if you get, it really depends on the acquisition, but if you've got share buybacks, it concentrates the investor's ownership in that equity and potentially is a creator of value, as long as the company doesn't buy back the shares at too high a price. So yeah, I mean, it is sustainable as long as we get new companies coming along, and you share a birthday with a FTSE 250. Brilliant. That's nice to know, Tim. And thank you for joining us as well on Patreon. It's nice to see you on there too. Okay, so next question from Tricks and Tracks. Hi, Ramin. How much of my income would be sensible to invest monthly? Well, really as much as you can afford. If you do have, I mean, obviously the first thing you do is you build up some kind of buffer. If you do have very expensive debt, you'd pay that down first. You know, all the kind of obvious things which make sense. But generally, you could try and save as much as you can. And that way, you know, once you've built up that buffer and then you start your investments, you know, if you over a long period of time, you'll be in great shape. And at a certain point, you may find that you've saved enough in order to retire. So, you know, you could retire early. But it's always good to have a goal, have a plan, and figure out exactly what it is you need. Because some people I speak to, you know, they've already achieved enough wealth that they don't need to take a lot of risk and they don't need to work. So, you know, if you're in that situation, it's great. But for many of us, you know, we're not in that situation. So we do have to save as much as we can and have a good idea of what you'll need to live once you do retire and roughly what age you want to retire. And then if you know how long you'll live, you can pretty much work out, based on an assumption about inflation, what money you'll need in retirement. But really, you know, you want to have some kind of safety margin built into that, because the last thing you want is to run out of money before you pass away and then you're dependent on your family to look after you. So yeah, I mean, generally for most of us, you save as much as you can. But obviously, you know, you still have to live. So enjoy your life as well. So David Garth says, good evening. Good evening. And Elaine, good evening again. And okay, so what else? Here we go. Yep. So next question is from Julian. Oh, okay. So there's actually a question from Alain, I think. Oh no, there's a question from Randy. Here we go. Can you get a factor fund that's in bonds as well, like 60-40 momentum? I'm not aware of one actually. There are papers published on momentum factors for fixed income, but I haven't seen many funds which give you access to that. In fact, almost all of the factor funds which I've seen in practice are equity ones, but I'm sure they must exist. If they do exist, it'll be in the US, not in the UK, because generally they've got a much wider choice of funds. But yeah, I can't see that happening in the UK. At least I'm not aware of any in the UK. So good evening, Leonard Nebelschutz, and good evening, Black and White. Okay, so there's a question from Alain. Zaman RDSA stock price, being an energy company, is correlated with oil prices. If you think the economy will recover and energy demand will increase, you could think of investing in energy. True. Somebody's saying, are the likes turned off? I hope not. So you should be able to like our stream. Please do, if you do like it. Alex says, hi Ramin, great content. Thank you very much. Keep it coming. I will if you support us. So please do support us. I'm also a Vanguard investor and want to understand the difference between the Vanguard emerging market funds. Thanks. So, I mean, they have an emerging market equity fund. They have an emerging market sovereign debt fund. So obviously one of them is lending money to sovereign governments in emerging markets. The other one is buying equity in emerging markets. So that's quite different. And I believe they've already got ESG funds in emerging markets as well. So if you are worried about ethical investing, then you might consider one of their ESG funds. I'm not absolutely sure about the ESG EM fund, but I think it does exist for Vanguard. But that's the primary difference, so you've got the equity and the sovereign wealth fund. And if that's, what am I talking about? You've got the equity and the sovereign debt fund, not sovereign wealth fund. So if you do, if that's not what you meant, just ask again at the bottom of the stream and I will try and answer if I get to it. Okay. And Julian Schmal says, what's your opinion on the following? Diversification protects wealth. Concentration creates wealth. Okay. So in that case, I'll just buy one stock and I'll put my entire life savings into it. Also take out a mortgage so I can buy more of it and, maybe take out a loan. Would that be wise for my investments? I could be lucky. I could make incredible returns, leverage returns, or I could lose everything I have. So that's the thing is, if you don't diversify, then a lot of people have lost a vast proportion of their wealth. So remember that single companies can go bust, single bonds can default, and that's why we diversify. So as always with these things, there is a certain continuum. So obviously you don't want to concentrate too much of your wealth into just a few investments. If you diversify across everything, maybe that's going to dilute your returns. But generally, if you do diversify globally, you've actually done very well over the last decade, and you'll probably do quite well in future. And you don't have to take such a big risk. So I'm not completely happy with that statement. So concentration potentially creates wealth should be the slight modification of that second clause, I'd say. Because concentration can also create financial ruin. Maybe add another clause. Okay. Leonard Nebelschutz says, lots of cheering around factors currently. What's your personal opinion on momentum and low volatility? Where should the increased risk required for the return come from with these factors? Well, funny you should ask that, because just today I was looking at Vanguard factor funds. Let me actually share my screen so you can see this, because it's kind of interesting. Yeah, so I'll do picture in picture. I'll make myself a bit smaller. Go into the corner, even smaller, and start R. So there we are, you can see R. And what you can see on the right hand side here is this is the factors. So there are 4 factor funds produced by Vanguard in the UK. And what I've done is I've stripped out the global equity correlation, or at least the global equity returns. So what we've got here are pure factor returns. So this is the pure alpha, which is the return above that of the market for these 4 factor funds. So the red line here is minimum volatility, and the purple line at the bottom, which has lost 25% of its value, is value. And so value was pretty much generating no alpha until the beginning of 2019. That's starting from its inception at the end of 2015. But then suddenly at the beginning of 2019, maybe a couple of months in, we saw, and value was a massive drag on returns. And we got a huge drawdown in value. But then it drew down again due to this sell-off that we saw in March. And what's interesting is that it hasn't recovered at all. Huge drag on returns globally. So if you have got exposure to value, you've really suffered. Particularly Vanguard Value, you will have underperformed. Whereas minimum vol did very well until probably October 2019. Then it started to go off a bit, and since the March sell-off, that thing's been plummeting as well, which is unfortunate because it's one of the funds that I own, one of the 3 funds that I own, and that's plummeted in value, and that's been a drag since that March sell-off. The 2 which are doing extremely well are momentum, which is the green line here, which has done very well since the sell-off. It's recovered a lot, and low liquidity. So that's usually small caps. So those 2 have performed very well since the March sell-off. But yeah, I guess my point is that, with these factor funds, you can never tell a priori which one is going to be the outperformer. So, I mean, that's generally why you have to choose one and kind of stick with it over the long term. But in terms of what my views are, well, my revealed preference, if you like, because of what's in my portfolio, is to go for minimum volatility. Oh, excuse you, Teddy. Oh, my dog's just groaning on the floor there.
It was not me.
Right. So, obviously, Teddy's not a very keen factor investor. There he is. Can you see Teddy down there? Yeah. It's very rude, Teddy. Right. What would the increased risk required for the return come from with these factors? Well, I guess the increased risk is that they don't continue to outperform, and there's no guarantee that they will. So you've really got to choose one that you're happy with and stick with it. And I've chosen minimum volatility. So, if you don't believe that factors can outperform long term, then obviously you wouldn't buy them. You just buy a diversified global fund. But remember that what I showed you there was pure alpha. I'd subtracted the global equity correlation from the returns of the fund. So you'll actually get global equity growth with either an outperformance or an underperformance due to the factor returns that you just saw. So yeah, I mean, I don't think there's a huge risk for any of those factors. They'll all have global equity performance with either a drag or a boost from the factor. but obviously value's suffering quite a bit at the moment. That won't carry on forever because these things are probably mean reverting. Okay. Ivor Sexton, please you could join us. Yes, nice to see you. Alex Burt says, yeah, we've already answered that one. Badar Zaman says, thanks, Alain. And this is a discussion about oil prices. And here we go. And then the next question. What's your view on emerging markets in the next 1 to 3 years? Well, it really depends on the emerging market. I think my difficulty with emerging markets is that it's a very broad term for countries which are extremely different. So let's take 2 examples, for example. Today I was reading about Turkey, and Turkey has very unconventional monetary policy, and its currency's weakened a great deal as people lose faith in their ability to manage the economy in Turkey. And remember that they've got a huge amount of debt, a lot of corporate debt which has been issued, but also a lot of sovereign debt which has been issued. And so the worry is that if they do get a huge depreciation of the Turkish lira, then it could be the case that we're talking about a default. I mean, we're a long way from default at the moment, but certainly corporate defaults could increase, and we could also see the potential for certainly a weakening of the currency, which may lead to a sovereign default. So I'd just be concerned about comparing Turkey with China. Now, China has huge amounts of foreign reserves. It's got a very strong economy, which is still growing very rapidly. It's recovered from the coronavirus largely, and its exports obviously haven't recovered because they depend on the countries it exports to. But the economy in China, remember, is primarily a service-driven economy, like a developed market. So the word emerging market covers such big extremes in such different countries that it's almost meaningless. But where will growth be greatest over the next 30, 40 years will probably emerging markets, simply because for some of those countries, the demographics are very favourable. They've got more young people. They've got a greater growth rate. They've got an increasing middle class in many of these countries. And probably they'll get greater earnings growth over time. The drawback with emerging markets is always things such as corruption, misallocation of capital, and political instability. All of these can cause a problem. And then you've also got things like unconventional monetary policy or downright very bad management of the economy. So those are the concerns you might have with emerging markets, which usually you don't get with developed markets. But will there be an excess return over the next 20, 30 years? Probably. And if you read Dimson, Marsh and Staunton's outlook, they expect that it'll give a roughly about 0.5% extra return compared to developed markets over the long term. So not huge, but still better than developed markets, probably. So yeah, I mean, I completely buy that argument. I think that's something to consider. Would I concentrate in a particular emerging market country? Probably not, simply for those reasons, which are that, you know, there's a lot of risk if you do allocate capital to EM. But that's where you get the higher return, of course. Higher risk, higher return. All time to drink my branded drink. So let me just say, as well as I have my refreshment, please do support us on Patreon. If you are part of our community, then you get these calls, but you get it with a much smaller crowd, and so it's much more likely we'll answer your question. Also, you get to ask your own questions, and then we create our own library of videos which only members have access to, and that's growing all the time. And by definition, those questions are interesting to lots of people because the community's asked them. So I know that they're interesting, at least for our community. So by becoming part of the community, you get to create your own questions, which I answer. which only you'll have access to. And you get access to all the other people, which is great at the moment because we have over 400 people who are on our Slack channel, many of whom are very active and who help each other. Plus, once you learn more, you can help other people too. So there's a good feeling you can have from doing that. So please do support us. It's $10 a month. Just go to patreon.com/PensionCraft. There'll be a link in the description. And do like the stream. That would be great. I see currently we have just under 200 viewers, but only 89 likes. So please do like the stream. It helps us. And I'll move on to the next question. Okay, what have we got? We've got Rushar, who said, Alain says, buy Ramin's book, guys. Books, guys. Invest in Fear. And he gives a link to it and a financial bestiary. Yes, I've written 2 books on investment. I should say Invest in Fear is to do with volatility investing, and a financial bestiary is pretty much for investing professionals. So lots of options and derivatives in that one. Probably more suitable for people who want to move into investment banks or asset managers or hedge funds. So it's more for professional investors, I'd say, but interesting for everyone, probably. Okay. Right. So why is the new lockdown? So this is Rushar. Why are the new lockdowns not affecting the stock market? Well, I suppose in a way they are, because, I mean, it's hard to know what would happen without the lockdowns, right? And we have seen certain areas suffer as a result of lockdowns when they're announced. So, in the US, they're not locking down anymore in many regions, so it's hard to know what the effect of the lockdowns would be. But, I mean, generally equity markets depend on global earnings. Often companies are multinationals if they're big enough to be in an index. So perhaps for those companies, lockdowns in a specific country wouldn't be so important, particularly if you buy a big index, which has hundreds of stocks in it and exports to many countries and generates its earnings from many countries. So lockdown tends to be a local thing, particularly in this later stages of the pandemic. Well, I see we've got 2 super chats. Thank you for that. And the first one's from David Garth. Can you provide guidance to calculating book value or guide us towards sites, tools to help with this? Well, yeah, I mean, this is, I guess the reason why you're asking that, David, is because you want to know about price to book value, which is a valuation method. Now, book value is kind of like the accounting definition of what a company's worth. So if you were to sell the company, what would the accountant think it was worth today? Unfortunately, for many companies nowadays, particularly software companies, book value probably isn't a great way of valuing a company, because things like intellectual property are very difficult to price. But personally, I think I still prefer earnings as the denominator in the price to earnings ratio for a valuation measure. But yeah, book value, I mean, any kind of book on valuation would be a good way of doing that. Maybe have a look at Damodaran stuff, Aswath Damodaran. I'm sure he discusses it. It's definitely in his book on valuation. Yeah, any kind of valuation book would probably have that. Or even Investopedia will give you an idea of what book value is. But yeah, as a kind of universal valuation tool, I'm not really that into book value. And the question from Hisham Daoudi says, is it financially irresponsible to have all my equity in ESG index funds instead of benchmarks? How much less profitability will I be looking at and why? Well, ESG, so okay, the point with ESG is that usually they take some parent index and they apply some kind of ESG filter. So, if a company's badly governed, or if it doesn't have, if it's a polluting company, or all of the other criteria which make up ESG, then it'll be crossed off the list. Now, usually the index and the parent index, the ESG index and its parent, are very similar, unless the parent index has a lot of dodgy companies in it, according to the ESG criteria. So let's imagine we've got the FTSE 100. That has a lot of energy companies in it, which usually fail ESG filters, in which case the ESG version of the FTSE 100 would be very different to the parent. So really it depends on the index you're talking about and the parent index, but there needn't necessarily be a lower profitability just because a company satisfies ESG criteria. In fact, if the governance is good, then they may actually be more productive. So I don't think there's an obvious effect on profitability. And it's certainly not irresponsible to have all your money, all your equity investments in an ESG index. I don't think that's true at all. And in the future, I suspect more and more investment will be put into ESG funds or impact funds. So, yeah, I don't think that's irresponsible at all. I think I missed one of those.
Do you want me to read it?
Yes.
When you withdraw from a Vanguard account, do you have to pay any taxes?
Oh, here I've got it. Ceramis. Brilliant. Yeah. Thank you, Ceramis, for asking the question. And thank you for joining us as well. Nice to see you again. When you withdraw from a Vanguard account, do you have to pay any taxes? Depends on the account. So if it's an ISA, so that's an independent individual savings account, an ISA, the idea is that the money's already been taxed before you put it into the ISA. And that means you don't have to pay tax when you take the money out. But what does happen is you lose that cash's tax invisibility. So once you pull the money out of the ISA, then you can't put it back in. You've essentially lost the tax invisibility. But in the case of a SIP, a self-invested personal pension, it's slightly different because there you haven't paid tax on the money before it went in. So you do pay tax on the way out, except for a 25% lump sum. And for a general investment account, which isn't tax sheltered at all, then you'll just pay capital gains tax and income tax if you're above the threshold. So you just have to put in your tax self-assessment. So it really depends on the type of account. And in America, it's a completely different system. Okay, so I hope that answers your questions, Ceramis and Hisham. And we'll go on to the next question. Bridgewater. Oh, have to be careful what we say there. Okay, nice slippers. Oh, thank you very much. I think that's referring to Laura's slippers. Yes, they are bunny slippers, in fact. And if Teddy's naughty again, they might be Teddy slippers. Okay. Hi, Ramin. If I want to invest over 7 or 8 years horizon, this is Rauno04. Oh, no, there's more before that. Okay, well, we can move on to that. Somebody says, have you got your branded drink tonight? Yes, I do. Here it is. Okay, here we go. Is there a non-currency hedged US Treasuries fund on Vanguard? Yes, there is, Jeff. Very easy answer there. And but it's not an ETF. It's a fund, not an ETF. So it's an open-ended investment company rather than an exchange-traded fund. Or vice versa. So the ETF, I think. Yeah, so the Vanguard... Yeah, I'm not sure about that, but I think they're both. There is a hedged and an unhedged one. The one I happen to have is the hedged one, the currency hedged one. Yeah, and just ETFs. So somebody says, Alain says, you can just check on etf.com. I think it's in answer to a previous question, but yeah. Okay. What do you think of 50% asset allocation to stock picking in UK AIM listed stocks, long-term buy and hold? Okay, so who's doing the stock picking would be my first question. Now, AIM is the alternative investment market in the UK, usually small caps which haven't satisfied the criteria to get a full listing on, say, the FTSE small cap or the FTSE 350, within the FTSE 350. And that means if they're small caps, they've got a much higher risk of bankruptcy, particularly in this kind of environment. Because remember, there are certain knock-on effects of the pandemic. So it might not just be retail companies which are going to be affected by the pandemic, but the people who depend on those. So there could be second order effects which are hard to predict in terms of which companies go to the wall. So I'd be very careful about investing in AIM during a period of economic weakness, which is what we're seeing right now. Because remember, once these furlough schemes end, then we're going to see probably some real financial problems. So just be aware of that and be very careful about investing in small caps like AIM. I mean, even the UK, having 50% of your allocation in the UK is a very, very, very big bias towards the UK. Remember that the UK is only 4% of global equity markets. So even having an 8% UK allocation has a huge overweight for the UK, which would suggest that you think the UK is going to do hugely better than, say, the US or any other country in the world. So just be careful about having too much in the UK, too much in small caps, too much in potentially weak balance sheet investments. Now, presumably by stock picking, what you're saying is that you look at their accounts and you choose ones which had a strong balance sheet. You could say that. But remember that active managers who work for asset managers, they spend 24 hours a day, well, many hours a day, thinking about investment. They've got entire research teams. They've got a Bloomberg terminal. They've got access to research from investment banks. They can actually talk to the management of the company via those investment banks to work out how things are going during blackout periods, obviously. So they have a massive advantage to you, and yet they still manage to underperform the global market or the wider market 80% of the time. So you've got to be honest with yourself. Do you think you could outperform a broad index given that you don't have those resources and that kind of time? I think it's unlikely. So you've just got to be honest with yourself. How likely is it that you think you could outperform by doing stock picking? And how likely is the UK to outperform given the fact that we're dealing with Brexit and the fact that we have this pandemic, which has hit us very hard in the UK? And we're getting now. So there's a whole bunch of reasons why I'd be really cautious about having that kind of allocation. So what you've said, George, disturbs me deeply. I'd be really careful about that. Certainly, it sounds like you're taking a lot of risk there. Okay, and let's move on to another question. Rowan04 says, I want to invest over 7 or 8 years. I'm interested in either Vanguard Life Strategy 80%, Vanguard All World Index ETF, or S&P 500 ETF. Which one would you go for? Okay, so if it's just one fund you're looking at, then I'd go for the diversified one, probably Life Strategy 80 personally, but you asked me what I'd do, that's what I'd do. All World Equity is just equity. S&P 500 is just equity in the US. So yeah, I'd probably go for the one which is more diversified. But hey, that's just my preference because I'm cautious. I'd like to have the comfort of 20% bonds in that portfolio. So that is my answer. So Saravana Natarajan says, I'd like to buy NASDAQ 100 via Fidelity UK. Okay. Right. Okay, that's a statement, not a question. Which one is a low-cost fund here? Okay, well, off the top of my head, I'm not sure. I mean, obviously, if you just have to look up the ongoing charges figure for those two. Oh, I see. You're comparing two. So NASDAQ 100 via Fidelity. There are two choices. One from Invesco, one from iShares. And you're saying which is going to be cheaper. Well, I've certainly seen a NASDAQ tracker, which is 0.3%, I think, off the top of my head. So that would be quite a reasonable fee for a NASDAQ tracker, because it is liquid equity in a developed market, the US. So that should have a low trading cost and a low ongoing charges figure. So you should be able to get that fairly cheaply. But again, do look at Just ETF, because that lists trackers for NASDAQ 100 and you'll see which one's cheapest. Right. Soon to retire, the other Mike says. Soon to retire. Can you comment on the Vanguard Wellington fund for retirement? No, because I'm not familiar with it, so I can't comment. So I can't comment, no. Hi Ramin, where do you suggest investing for 3 years and under? Well, I mean, over a 3-year period, it's very likely that equity could crash. So just make sure that you don't put too much into equity for that very short time period. Usually equity is for ideally a decade or more. So you should be thinking about fixed income, preferably the safer side of fixed income, so not high yield, maybe investment grade credit at the riskiest, probably government bonds, probably fairly short duration. So, over a 3-year period, you need to be pretty cautious and have very limited expectations for return, because you will get low returns for that low risk investment. But, if you need the money in 3 years or less, then yeah, equity is a very risky proposition. Okay. Badar Zaman says, if I don't want to invest in individual shares or stocks, which company or fund shall I use to do the investing for me if I can contribute $500 a month? Okay. Well, you could... I mean, most wealth managers, it require you to have, like 200k, so they won't do it. But what you can do is set up a automated investing, so regular investing with some of these platforms, because what you do is you just set up a portfolio that you want. So let's say, I don't know, Life Strategy or MyMap, or it can be a single fund. And then every month you guarantee that you'll be able to do a direct debit from your checking account, and I think they give you a much reduced charge for, if not free, trading in order to do that regular investing. But it's automated in the sense that you always put it into the same portfolio. So you can set that up with, I know that Interactive Investor allows that. I think others do too, maybe AJ Bell, I'm not too sure. But it's called automated investing or regular investing. If you Google that, you should see it on Interactive Investor, and you can find it for the other brokers. But that's probably the cheapest way to do it. And then you don't need someone to do it for you, because effectively it's done for you. It's automated, and all you've got to do is choose the funds you want to invest in. And you can just use a multi-asset fund, which has low fees and which would probably do quite well. So that would be something like the HSBC Global Strategy Funds, which are like Life Strategy, very cheap, diversified, 5 different levels of risk. So that could be something to consider. And that way it's very simple, probably is diversified. Well, it is diversified, and it'll probably perform quite well. So, yeah, that might be a simple way of doing it. And Deepak Singh says, like the stream, everyone. Yes, please do. Currently, we still have 133 likes and 222 viewers. So please do like it if you would. And we'll move on to the next question. Is having multiple apartments in a city centre not much safer for retirement than stocks? Well, the difficulty with apartments in a city centre is all of those apartments will be in one country in one city, and if you get an economic downturn, then the value of equity, the value of the property will fall. So it's very difficult to diversify physical property unless you can buy one in Singapore, one in Japan, one in, I don't know, Hong Kong, one in Australia, one in the UK. You get my drift. It's very easy to diversify equity, but it's very difficult to diversify an illiquid investment like a investment in property. And remember that when equity markets sell off, you can easily sell. Liquidity remains. But if property markets sell off, you could be left holding a loss-making property, and if you borrowed money to buy the property, then you could be left with negative equity, in which case you'll be locked in until prices improve. So just be aware of the illiquidity of that property, but also the concentration risk that you get with property, and also the minimum investment for property is usually very big, whereas shares you can buy for, sometimes a few pounds or a few dollars. And now we can have fractional shares, whereas you can't buy fractional flat very easily. So those are the considerations, I'd say. Plus there's a carrying cost, and there's kind of things like maintenance that you have to consider, and taxes, all sorts of complications for property. Brian says, which ETFs have minimum volatility during this crash? And what do you think about renewable energy stocks indices in the future? Well, which ETFs have minimum volatility during this crash? Well, you can get a minimum volatility ETF. In fact, in my portfolio, that's what I've got. But generally, the ones which have a low volatility will be the ones which contain lots of fixed income. So the lowest volatility will be short duration government bonds in your local currency. And then if you increase the duration of the government bonds, the volatility will increase. And then you've got maybe developed market equity would be the next level of volatility. And then emerging market equity and real estate investment trusts would be the most risky in terms of vol. So in this kind of environment, that's probably the risk hierarchy as well. All that happens during a very volatile period is all of the volatilities move up and down together, but usually the ranking, the lowest to highest volatility will remain the same. Just the levels of volatility all move up and down together. Okay, and what do you think about renewable energy stocks indices in the future? Yeah, I think that's the way things are going to move in the future. Oil is obviously not a kind of structural play, because now we're seeing a world in which we've probably reached peak oil. The oil companies don't think so. I was reading in the FT today, but I think most people are moving psychologically away from a dependence on oil. And we've got a super chat, so I'll switch to that. Colonel Spons says, how does Robinhood make money on 0% commission trades? Scaling zero to large volumes is still zero. Okay, so remember that Robinhood, what they may not tell you is how they execute the trades. So it could be that, they take a cut by providing, so there are various ways they can do this. I know there was selling information about customer behavior to third parties just to get a feel for, and those third parties were buying Robinhood information on trading, maybe not individual data, but certainly aggregated data to get a sense of sentiment. So it's always interesting to see what people are doing, retail investors are doing. And many professional fund managers may be interested in that, so they'll buy that data from Robinhood. So that's one way. Another way is, let's say you place a trade. The probability is that Robinhood will aggregate that with other people's trades, and the price they get may be different from the price that you see. So they may take a cut on the trade as well. So that's another way they can make money. So, in terms of the execution of trades, that's another way they can profit from their customers. So that's probably the two ways they can do that. Maybe they also make money by cross-selling other products. I don't know. I haven't used Robinhood. I can't because I'm in the UK and they're not going to launch here. So that's probably how they do it, though. Okay, we've got another question from David Garth. Would you say you're a conservative investor? You focus on funds, not keen on individual shares. Is this your nature or due to your investment horizon? Well, I always try to base things on data, David, because my background is in physics, but I am cautious. It's just that things like the SPIVA report, the S&P Index versus Active report, I've done a video on it, I've done more than one video on it, shows that active managers fail to beat the market a very large proportion of the time, 80% of the time on average, and for particular sectors even higher. So if they can't beat the index, then I don't think I can stock pick better than an index. So it's really admitting that I don't think I can beat a market by stock picking. Also, I don't have time because I'm running PensionCraft to do the stock picking. So even if I did have the resources, I mean, one feasible path for me might have been to become a fund manager. I could have done that, I suppose, but my choice was actually to educate people about investing. And the first thing I wanted to tell people was this result from SPIVA, which I think is fairly earth-shattering because it shows that if professional investors can't beat the market a lot of the time, then neither can you. So it's not just my caution, it's self-knowledge. I don't think I can beat the market. And I think, to be honest, neither can many of the people listening to this call. So that's why. Leo says, thank you for your super chat as well. Hi, Ramin. Given the historic success of index investing, are there any niches or sectors left where active management still makes sense? Yeah, I think my issue isn't with active management. My issue is with the way the way the fees are structured. So the problem is that the fees are fixed. So let's say you buy a very popular UK active fund, which is Fundsmith. They charge over 1% active management fee, and that's whether they succeed or whether they fail. So in 2019, they didn't have a great year, but they still charge 1%. And in future, if they underperform, they'll still charge you 1%. Whereas companies like Orbis, asset management, they actually don't get paid if they underperform. So they have a performance-related fee, and they pay you back a fee because they have a slush fund when they have a good year, and then in a bad year they'll pay you back some of that slush fund. So it actually reduces your fees. So I think my issue is more with the fee structure and paying someone to do something whether they succeed or fail. If you compare that with any other industry, so let's say you had a builder who was going to build you a house and they said, well, there's a 1 in 5 chance that we'll successfully build this house, but there's an 80% chance we won't, but we'll still require you to pay us £100,000 to build the house. Is that okay? I mean, who would say yes to that? Or a taxi driver, there's a 20% chance we'll get you to your destination, but we could actually end up going in the other direction. Is that okay? No. Okay, it wouldn't be okay. So I think investment is the investment industry is a very odd one where people do think that's acceptable to have a 20% chance of success. So, yeah, I think if fees were more dependent on performance and you didn't have to pay a fee if they didn't outperform, yeah, great, because that aligns your interests with that of the fund manager. But if they charge you 1% whether they succeed or fail, then suddenly the game changes, and their job is simply to accumulate a bigger pot as possible and make 1% on that pot. So it's easier to market their fund, get more people through the door, than it is to invest time in outperformance, which is clearly not in your interest. So you're actually rewarding asset gathering, not rewarding performance. So that's why I think fee structures are so important. And very few active funds have that kind of fee structure unless it's a hedge fund, which most of us don't have access to. So that's my point, I think, why I don't like fee structures. Okay, so let's move on. Lennart V. Nebelschutz says, thank you, Ramin, got your point. Thanks for your scientific approach and underlying. Definitely helps to understand it. Great. LB says, with the best savings rates being so poor, how would you invest your money whilst balancing risk and profit? Well, I mean, many people have said that because real interest rates are so low, that means that the performance of assets will generally be lower in the years ahead. So low real interest rates means lower returns. So I think all you can really do is what you've always done, presumably, is to diversify, have an equity allocation that's as large as possible for the investment horizon that you'll be investing for. So if it's more than 10 years, a lot of it's going to be in equity. If it's less than 10 years, probably more in fixed income. And there's no kind of riskless return that you can get. So unfortunately, you've still got to take the risk for lower returns now. So that's the drawback in the current environment. So yeah, I think it's very difficult unless you resign yourself to lower returns, which most of us have got to do anyway, I think. I don't think we're going to see the kind of returns we've had over the last 2-3 decades in the next 2 or 3 decades. Right. So Sash Media 1, a good comment. So getting into a value factor now is a good idea. Yeah. I mean, if you're contrary, yeah, now would be a good time to buy a value factor fund. I mean, personally, I think value factor funds are underperforming because growth is tech. And tech, there are many reasons why tech's outperforming, but the primary reason is that they're generating a hell of a lot of profit. And so they should outperform. You know, it's kind of fundamentally justified. Perhaps valuations have got a little ahead of themselves, but, you know, value stocks are probably not going to outperform, particularly as value stocks generally tend to have quite thin margins. And if that's the case, then in a recession, as we're seeing across the world at the moment, then, you know, we're unlikely to see them outperform. So, yeah, I'd be very cautious about being too optimistic about value now. If you do want to invest in value, probably an environment which is better for that is when you're coming out of a recession and you've got more normal interest rates. So, you know, where long-term rates are around 5%, short-term rates are around, 2%, the way it used to be in the past. But it's going to take a long time for rates to normalize. And that's going to be a headwind for value and a tailwind for growth. Yeah, so I'm not convinced that value is going to outperform right now. Currently based in China, Black and White says, currently based in China, looking to invest renminbi-dominated equity bond ETFs with the help of my wife, who's Chinese. Oh, cool. What's your view on Chinese stock markets over the mid to long term? Yeah, I mean, well, it's a huge market. It's like a question like, what do you think of the US market? I mean, regionally, China, I think, is in pretty good shape in the sense that it's got a very strong services sector again now, because it has recovered from the pandemic. So over the short term, yeah, I mean, it looks pretty good for Chinese equity. But as always, the difficulty is with knowing what sectors are going to outperform. I mean, things like the tech sector is probably a good play in China, just as it is for the US. But I guess China faces many of the same issues as other countries, in the sense that things like retail, physical retail, is kind of a trend that's kind of dying, whereas online sales are a thing which is still doing very well. In China, people are still thinking about building infrastructure, so things which depend on infrastructure, if that continues. But again, that depends on political choices, which are very difficult to predict. But generally, the Chinese government is very much for continuing to build infrastructure. So China is still building 6 Londons equivalent in infrastructure every year in terms of the urbanization of China. So, yeah, I mean, it really depends on where you think the trends are headed in China. But if you're based in China, you'd have exactly the same problems, which is you'd want to diversify globally. You wouldn't want a domestic bias. And maybe capital controls are a problem, I'm not sure. But if you have to be in renminbi, then yeah, certainly consider which sectors are going to do well and which ones fit well with the political goals at the moment. Because remember that if you've got a centrally planned government, then the government's goals are much more important. So make sure you understand those goals and which companies fit with them particularly well. Yeah. So I'm no expert on the Chinese market, I should say, but certain principles apply everywhere. Okay, how are we doing for time? We've got 3 minutes left, so I better wrap things up in a moment. So I have one more question, I think, maybe 2. Yep, so I should say do like the stream. That would be great if you did. And we've got 167 likes, which is nice. What's your opinion about quality investing, Fundsmith, Cylern as a defensive strategy for current times? Oh, we've got a super chat, so let me just quickly answer that first. Talbot Sunbeamer, nice to see you again. No question, Ramin, just saying thanks for your time and effort. Always enjoy your Saturday videos. That's really kind of you. Thank you very much, Talbot Sunbeamer. So back to that question. Quality investing. So yeah, I mean, quality, for those who don't know, is stocks which don't have too much leverage, which have steady earnings growth. So generally the kind of companies which have been careful and which are successful. Effectively, you're kind of filtering out the companies with too much leverage, which can't grow their earnings, and which don't have a great return on equity or a return on assets. So yeah, quality, certainly in this environment, is probably a good choice, because if we do see a global recession, we are seeing a global recession, the quality companies are the ones which are going to do best. So certainly quality for the time being is a good play. Once we come out of a recession, people call this a flight to shite. I shouldn't say that, but people buy very low quality companies, they buy junk companies, and those are the ones which tend to do well coming out of that kind of coming out of a recession. But certainly at the moment, I think we're pretty much still in it for much of the world. So quality is probably still a good choice. Fundsmith, as I say, I've got issues with Fundsmith's charging structure. They didn't have a great 2019. Things like QQQ, if you just buy a NASDAQ tracker for 0.3%, a third of the fee that you pay for Fundsmith, you'd have beaten them hands down in terms of returns over the last decade. So You can certainly do better with passive, and certainly do it more cheaply. So I think that's about it. So we're just coming up to 8 o'clock. So thank you all for dialing in. It's been great to have you on the call. And for those of you who are watching afterwards, thank you for watching as well. And yeah, do like us and do sign up for our community. I think you'll find it useful. And there'll be a link to how to do that at the bottom of the video in the description. So that's patreon.com/PensionCraft. It tells you how to sign up. It's $10 a month and you get lots of goodies. You get to join us on Slack. You get one of these with a much smaller community every other week. And you also get lots of bespoke content and member-only content, which you decide on. So thank you all and have a great 2 weeks, and see you in 2 weeks' time. Good night.